Well, if you caught the show yesterday, you will remember that we showed you this chart of the S&P 500 forming what Brian Kelly called a megaphone pattern. Some are saying it's setting us up for a major drop. Our next guest is in that camp. Sven Henrich is founder and lead market strategist at NorthmanTrader. Sven joins us from London. Sven, it's always great to have you with us. So we didn't actually have a technician or some, interpret this chart for us, but what do you see here?
Hi, Melissa. Yeah, this broadening wedge pattern we've been watching actually for quite a few months and was interesting in the lead up to July, because in July, obviously, we had all this anticipation with the Fed rate cut. And the markets had been running in 2019 really from Fed meeting to Fed meeting, from Fed speech to Fed speech. And then when that rate cut came, we tagged that broadening wedge again for like 3 weeks in a row. But then we reversed, as a guy mentioned earlier, regarding the Trump tweet regarding new tariffs. So we definitely now have a technical validation of that upper trend line. And obviously, the question is, can bulls get above that trend line? It's not necessarily a bearish pattern, because if you can get above the trend line, defend it as support, and then rally on, you can argue you have a massive rally coming. The problem is, if I look at this, and I'm looking for validation here of some sort, is besides this megaphone pattern, we actually built what is called a rising wedge in 2019. And what I'm impressed about by all of these patterns is that they've been very technically clean. We go from these noisy headlines where markets get moved up or down on any given day for any reason, and yet these patterns have been clean so far. But what happened in August is that rising wedge actually broke to the downside. That's kind of your kind of classic warning sign. And so markets will have to repair that or face risk of further downside to come.
So can you bottom line that for us, Sven? I mean, as I understand it from the notes, you're still seeing a buyable dip sometime in the next couple of months. But after that, who knows?
Well, absolutely. Actually, what we're looking at here short term is there's a possibility if the VIX goes up to 28.30, there's currently a pattern on the VIX that suggests that is a distinct possibility. We may have a viable dip. Look, these megaphone patterns, this is a long-term structural chart. It's not going to play out in a straight line or in a few weeks necessarily. This could take on for months. And I think generally people just need to be aware that it's out there as long as it's not invalidated. And it's clearly not invalidated. So that's a risk for bulls, and it needs to be moved higher. And that means above that trend line. Otherwise, with a break of 2,700, for example, you're starting to risk that this pattern goes active.
Sven, I'm a big fan.
And the ultimate target of that one is 2,100.
I'm a huge fan of your work. I think you do extraordinarily thoughtful work, bullish and bearish. Is it just about the trade war, or is it about now, and you tweeted this today, something we talk about, U.S. debt to GDP 105%, give or take. 30% now of sovereign bonds have negative yields. Currency crisis or currency war. There's so many things other than U.S.-China going on that seem to be potentially negative for the market.
Yeah, I mean, obviously, if we get a China deal, we can have a massive relief rally for that reason. But I'm looking at it also from a larger cycle perspective. And what has happened in the last year and a half with central banks across the globe, I think has been incredibly insightful. I mean, look, originally the promise was that QE and low interest rates, these emergency measures were just going to be temporary. And then they morphed into this permanent aspect of the market structure, and central banks always intervened when markets got into any sort of trouble. And to the credit of the U.S. Fed, and I'm highly critical of them, they at least tried to raise rates and they tried to reduce their balance sheet, but it failed miserably last year as the 10-year got to 3.2%. The question was almost, this big debt construct that we've created over the last 10 years is not sustainable with higher rates. And we got that answer last year when we hit the 3.2% on the 10-year, and we've completely collapsed since then. So what is the central bank efficacy game here going forward? The Fed actually is cutting rates here with the financial conditions being the loosest in 25 years. It's unfathomable. When you have loose financial conditions, typically central banks raise rates. And what are they trying to accomplish here by going even looser than what we've seen before? I mean, look at the housing data you're getting with mortgage apps, with yields collapsing, the 30-year making all-time lows, we don't really see any growth here in the housing market. So what's the end game here in terms of efficacy? And I worry that obviously we are reaching a point where central banks can only do so much.
So going back to the structural view of the market, Sven, you think that without a China trade deal and with, as you mentioned, central banks seeming to lose control of what's going on here, that 2,100 on the S&P 500 could be in the sights of market participants?
Yeah, I mean, look, it sounds dramatic, but it really isn't if you go back to the 2009 lows. Actually, there's a technical level, a Fibonacci level at 38.2. It brings us back to the 2015 highs. It's actually, from that perspective, not dramatic. And ironically, that's kind of what the bond market's been signaling, right? The 10 years already back to the levels of the U.S. election in 2016. So again, if you have 9 major economies around the globe already either in a recession or at the verge of a recession. And this China trade deal, the longer it's been dragging on, it keeps kind of everybody here on the side playing with fire here, because I think this is why we're seeing these violent reactions now to every single news headline. I think the market is getting impatient. Market wants this resolved. And to the extent that this, again, gets pushed into next year, perhaps, I think markets will lose patience as we see Europe, for example, overtly flirting here with recession at this point.
Sven, thanks. Good to see you. Sven Henrich, a.k.a. NorthmanTrader. Steve, what do you make of Sven's levels?
You know, when we were at 28 and change, and I had seen in the charts 2350, that was a big drop, and we touched it. When you say 2100, I never discount any of this. And all of this is always possible. You always rip through. There's lack of support when people start to see blood in the streets. So is it possible? Yes. Is it probable? No.